welcome. I'm here in the Financial Times headquarters with Dame Colette Bowe, who chairs the UK's Banking Standards Board, which was set up in 2015 with the endorsement of the Bank of England, among others. The board has so far signed up 31 institutions, and it's preparing to issue its first annual report. Well, thank you very much for joining us. Obviously, we have regulators on the one side, we've got professional bodies like the Chartered Bankers Institute on the other. Where does the Banking Standards Board fit into the landscape? What do you see as being the main contribution that you can make?
I think the Banking Standards Board can make a pretty distinctive contribution. Regulators have, of course, a statement of the obvious, a very important job to do in determining where the boundaries are of what is lawful and what is prescribed by the regulations. What the Banking Standards Board is about how, on the basis that all of that is being complied with, a firm in this industry can go above and beyond to deliver something that reflects its culture, its desire to go, as it were, beyond compliance into the realm of this is what this business is about. So the Banking Standards Board is, I would say, highly complementary to the regulators. Neither of these things that we do are substitutes for the other. In terms of the professional bodies, again, there's a good and close relationship, I would say. One of the things that the Banking Standards Board has become very interested in is the question of professionalism in the banking industry. We'll be having a good close look at that in the course of 2016. And one of the things we will be doing is working with professional bodies on what is their offer, how does it align with the demands of the modern banking industry, and do we need to work collectively together to improve that offer, to make it more widely available on the one hand, and to encourage banks to, in turn, encourage their own staff to make more use of time for getting professional qualifications.
And one of the tasks that you did during the first year and is in the first annual report is this assessment of 10 institutions that was very in-depth. What were the main sort of lessons that were able to draw out of that?
Well, I think there were 3 or 4 big lessons that came out that were fairly common across the 10 institutions that we looked at. One, and this is going to sound like a statement of the obvious, but I think it's worth saying. One is the extent to which the development of a strong culture for a firm and the installation of that culture and the oversight of it is absolutely a job for the board itself. The board is responsible. This is not a job that is to be sensibly handed off to the compliance department or some other part of the firm. The board itself has got to take ownership and leadership. I think that's well understood by the 10 firms that we assessed this year. But I think one of the strong things that came out of our assessment is how much this job of leadership in the space of the firm's culture is something that a board has to be on in a very engaged way quite a lot of the time. You can't, as a board, believe that you've kind of got the culture that you want and then it's done. It's something that you have to keep on. So one big message, and I think it's a message that's completely recognised by our 10 initial firms, which of course is why they are the initial firms of the Banking Standards Board, is that this is a job for the board. Second big message, and it reflects something I said a moment ago, is the importance of professionalism. And that is more than just an aspiration. It means a commitment to training. It means a commitment to continuous training. It means firms being prepared to make available time for people to do that training. And it means that people who have undertaken professional training are appropriately recognised and rewarded for doing so. A third big lesson that, and again this is a statement of the obvious, but our reports indicated this, is the extreme importance of the work of boards' remuneration committees in reinforcing the kind of cultural messages that firms want to convey to those who work for them, what is rewarded. Nonetheless, very well worthwhile stating. And I suppose a final important message that came out of year one was the possibility of key man risk or key person risk. If you're in any business, of course, not just banking, that embarks on a process of putting culture right at the heart of your business development, any business where there is a strong CEO who personally commits herself or himself to such a program, any such business has to be very sure that there is good succession planning behind that person, so that there is no doubt at all inside the firm that the whole senior management, under the leadership of the board, is committed to carrying this through. Now, Philip, none of this is revolutionary, you're going to say. I can feel you thinking, well, that is all fairly obvious, isn't it? But it does need saying, it does need reinforcing. The boards to whom we've reported our findings have all told us that they have found a great deal in our detailed reports that has given them a lot to think about.
And in terms of the coming year, what would you say is the most important task that you're going to focus on?
I think in the coming year, our biggest task is going to be developing a new set of assessment techniques to enable us to work with a much wider range of firms. We have firms coming into membership now, so we are extending beyond our original 10, developing a set of techniques that will be wider than those that we've already used, new techniques that will enable us to take on board a wider set of influences, leading us very importantly to what I think is the crucial need for all boards in this kind of space, which is what are the metrics you can have that can tell you as a board whether your business is going in the right direction as you work to improve its culture.
Well, thank you very much. I'm sure we will read the report with interest.
Thank you, Philip.